Family, thank y'all for watching this video. Your support motivates me to post more content and give out more information. If your company is not in the S&P 500 and you have been losing with it astronomically year over year, back to back, sell that stock. Some companies will know that their stock price is falling and that the company is trash and can't support a long-term dividend, but they will still raise the dividend just to get more investors. So you already know that's fool. Family, don't fall for that. First thing we're going to go over is the PE ratio. What is the PE ratio? What is earnings per share? Earnings per share represents no pullback or no economic catastrophe ever made that SPY ETF stay low forever. Despite the Black Monday crash, high inflation, they was profiting 24 cents per share back in 2017. Now they're profiting $3.51 per share. What's good, family? I hate when investors or beginners be like, stocks don't work, investing don't work. Well, yes, it don't work because you're missing out on ratios that help you determine the value of a company, help you see the growth of a company, the financial health, and the income. If you don't understand these different fundamentals about a stock and you're investing in it, you're investing into it blind, and if you do something blind without analyzing it, you really could easily make the wrong decision easily. So today, family, I'm going to go over some easy fundamental ratios for you to understand. Not only that, I'm going to show you live right now how to look at those PE ratios and how to implement them in your trading strategy today. We're going to be using Finviz, TradingView, and this PowerPoint I made. First thing we're going to go over is the PE ratio. What is the PE ratio? It compares a company's stock price to its earnings per share. It tells you how much investors are willing to pay for each dollar of earnings. PE helps you assess whether a stock is cheap or expensive relative to its peers. A high PE may signal growth expectations or overvaluation. A low PE may indicate value or trouble ahead. If it's under 15, it may be considered undervalued. If it's between 15 to 25, it may be considered fair or average. If it's over 25, it could be considered a high growth stock, maybe like tech. So if a tech PE ratio is normally above 25 and it falls to 15, it could be considered undervalued, but you always want to assess it relative to its peers. So in the same industry, you don't want to compare a finance PE ratio to a tech PE ratio because a finance PE ratio stock gonna be way lower than a tech. So compare them into their respective industries, you feel me? What is earnings per share? Earnings per share represents the portion of a company profit allocated to each outstanding share. It's the most direct measure of a company's profitability on a per share basis. Why it matters? Because EPS growth is the engine behind the stock price appreciation. Consistent EPS increases signal a healthy, expanding businesses. Declining EPS is a major red flag for investors. So this is what we're going to do, right? We're going to use the SPY ETF. Why we're going to use the SPY ETF to find some stocks to look at? Well, because the SPY ETF was created in 1993 and it has been performing well ever since. If we check out the compounded annual growth rate, it's over 9% for the 20 years, right at 9% for 20 years. And it's over 9% for the rest of the years. So this is the most stable, consistent ETF created by State Street, some of the best investing managers of all time. Not only that, this ETF is very resilient. No pullback or no economic catastrophe ever made that SPY ETF stay low forever. Despite the Black Monday crash, high inflation, stagflation, Gulf Wars, no wars ever made the ETF go to hell. It's gonna always recover, you know what I'm saying? So whenever you see SPY pull back 20%, get your funds ready because it's gonna go up 30%. Which stock we wanna look at? Let's look at now stock. Just go to Finviz, go to MAP, S&P 500, and go to 1 year performance. We're going to go over the now stock. Let's see. I'm actually in now. Got a little starter position in there, nothing too crazy. We're gonna delete the drawings on there because we're not really talking about the drawings right now. Look at this oversold on the RSI, but we're not really talking about the RSI. It did miss earnings a little bit, but let's go look at the numbers that we just said we was gonna look at, right? So boom, Earnings per share. Earnings per share represents the portion of a company profits allocated to each outstanding share. So let's check it out. Rising EPS year over year is positive. EPS beat estimate is bullish. Let's check it out. Let's see if it's positive. Earnings per share. Look how much they're profiting per share. They was profiting 24 cents per share back in 2017. Now they're profiting $3.51 per share. They're expecting to profit more per share every year. Boom, that's good for us. Let's check out their PE ratio. So they're in the technology services ETF, so it's going to be high growth. Like the PE ratio was at 940 and it has been falling since. What does that mean? It tells you how much investors are willing to pay for each dollar of earnings. So check it out. If investors used to pay $941 for each dollar of earnings and the company was great, at $55, it's even better. Revenue growth. Revenue growth measures how quickly a company's total sales are increasing over time, quarterly or annually. It reflects demand for the company's products or services. Without revenue growth, long-term EPS growth is nearly impossible. It is a primary signal for whether a business is expanding or contracting in its markets. Check it out. Over 20% is high growth, 10 to 20% is solid, less than 5% is mature and slow. Let's see the benchmark, what benchmark ServiceNow is on. And if we don't know what ServiceNow do, all we have to do is scroll down on TradingView. ServiceNow engages in the provision of an end-to-end workflow automation platform for digital businesses. Its Now platform is a cloud-based solution embedded with artificial intelligence and machine learning. The company was founded in 2004 in Santa Clara, California. Let's check out their revenue, see if their revenue is growing. We're going to check it out on the annual because we want more though. More data we have, the longer we can hold this position. You know, the more data we have, the more information we have, the more we know about the company, the more we can invest and the more time we can be into them. You feel me? So let's check this out. Their total revenue in 2012 was $244 million and it doubled. And it's been going bonkers, you know what I'm saying? They hit $1 billion in 2015. That was right at $2 billion in 2017. $6 billion in 2021 is increasing by the billions. They're at 13.3 bill right now. You got a percentage of how much their revenue increased on a percentage basis year over year. So yeah, this is definitely a high growth company. Without revenue growth, long-term EPS growth is nearly impossible. Debt to equity ratio. It shows how much a company relies on debt financing versus shareholder equity. It's a key indicator of financial leverage and risk. High debt loads can cripple a company during downturns. A low DE signals financial resilience, while a high one means the business could struggle if interest rates rise or revenues dip. Let's check this out. A good debt to equity would be below 1.0. 1 to 2 is moderate. If it's over 2, it's risky. They have too much debt. Let's check out now debt. Hit statistics right there. We on the annual still. Let's scroll down. Check out all of these ratios. It would be a good idea for you to click and learn the definition of each of these ratios just to become a more knowledgeable and better investor. Debt to equity ratio is 0.21, very low. You know what I'm saying? Very low. Balance sheet, liabilities to assets, 50% low. Free cash flow, the cash a company generates after spending on maintaining or expanding its asset base. It's often considered the real earnings of a business. Why does it matter? Free cash flow is what funds dividends, buybacks, debt paydown, and acquisitions. Sustained positive free cash flow is a hallmark of a high-quality business. It can't be manipulated like net income. Positive and growing is strong. Free cash flow yield over 5% is attractive. Let's check out now free cash flow. Hit statements, and you will hit this search bar. Instead of clicking each one of these tabs, if you want to see all these tabs on one slide, on one page, just click in the search bar, scroll to the bottom, free cash flow. We get to see it from here. Boom, free cash flow has been increasing astronomically. Free cash flow was $26 million jumped up to 84,227,000,000. Major decrease in 2016. We'll have to research why that happened. But check it out. Since 2017, it has been increasing astronomically. So they have a very attractive free cash flow and is positive and growing very strong. Return on equity measures how effectively management uses shareholder capital to generate profit. It shows how much return the company earns on every dollar of equity. A high return on equity indicates a competitive advantage. Companies that earn more from less equity tends to compound with powerfully over time. Buffett looks for return on equity greater than 15% consistently. Let's check out return on equity. If it's over 20%, it's excellent. 15 to 20% is good. Less than 10% is average. Let's check out now. We're back on the statistics page. We're scrolling down to profitability ratios. Let's check this out. It was negative 38%, very good. Back in 2019, we got to see why it's been decreasing like this and make sure it won't keep decreasing in the future. But check this out, their return on equity is right at 16% pretty much. That is good, you know what I'm saying? They're profitable. They're making a return on the shares that they sell, you know? They're generating profit. Dividend yield. A dividend yield expresses how much a company pays out in dividends each year relative to its stock price. It represents the income return on an investment. Dividends signal financial stability and management confidence. For income investors, yield is essential. Watch for yield traps. Very high yields can signal a struggling company. Check this out. 2 to 4% is a healthy dividend. Over 5% is a high dividend. You want to verify and make sure that the payout ratio is still good, because some companies will know that their stock price is falling and that the company is trashed and can't support a long-term dividend, but they will still raise the dividend just to get more investors. So you already know that's fool. Family don't fall for that. Check out the pay-e ratio is less than 60% is safe. So if it's high, verify with that payout ratio. If the payout ratio less than 60%, cool. One of my favorite dividend stocks right now is UPS, but I fear that UPS fail a couple of these metrics that we just went over today, so I won't cover them. But check out now dividend yield. They don't offer a dividend, which is cool. Some stocks don't offer a dividend, which is cool. If you're a dividend investor, of course, you're going to want stocks that offer a dividend. Family, thank y'all for watching this video. Your support motivates me to post more content and give out more information. Today, we went over some very important valuation metrics, some metrics that help you understand what companies earn and will it continue to grow, what their balance sheet look like, how efficient the company is running. Here's a slide of the cheat sheet of the formulas that you need to look at on every company you analyze. The first thing, I really highly recommend you going to Finviz and analyzing companies in the S&P 500 index first, just because you want to be investing in companies that have been performing long term, that's profitable, that's been growing. So if you're investing in companies that's in the SPY index, you're already filtering out a lot of unprofitable, trash, terrible companies. If your company is not in the S&P 500 and you have been losing with it astronomically year over year, back to back, sell that stock, get out of it, get into something new. Never risk more than 50% of position. If the stock price can fall 50% or more, just wait. It's too high, you know what I'm saying? I only invest in stocks that I know won't fall 30% or more, so I gotta wait for that big dip, you know what I'm saying? The market at an all-time high is gonna dip soon, so you want to use these metrics to find companies on a good dip that are healthy, you know what I'm saying? Peace and love, family. Hope y'all have a great day investing, and I hope y'all learned a lot.